S&P Global has become the latest international ratings agency to herald India as the fastest growing economy next year. Before this, Moody's, Fitch and others have said the same thing, that India will grow faster than any other major economy in FY24. The S&P forecast is being feted and touted as another example of India being a bright spot in an otherwise gloomy outlook. And indeed, HSBC today has forecast that the United States will be in recession this year and Europe in 2024. Meanwhile, India is expected to grow at 6.7% on an average over the next 3 years. But let's look more closely at that 6.7% average number. Now, remember, for the financial year 2023 that ended on 31st March and the numbers just came out, India grew at 7.2%. That's higher than was expected. This has improved the outlook on growth. But for next year, that is the financial year ending 2024, we are expected to grow at 6%. In the following 2 years, we rebound to 6.9%, which is why the average 3-year growth at 6.7% becomes the fastest in the Asia-Pacific region. Now, according to S&P, domestic resilience and private investment have made India more attractive. This is obviously good news for the world's largest population, and S&P is not the only one saying it. For this current financial year, which means from April to March, the RBI says we'll grow at 6.4%, Moody's at 6.5%, ADB at 6.7%, Fitch at 6.3%, World Bank at 6.3%, and IMF at 5.9%. The outlook is positive based on the Indian consumer and her ability to spend, a large domestic market, government schemes like PLI, a big spend on infrastructure, etc. On the other hand, there is little doubt we are in choppy waters globally. The ongoing Russia-Ukraine war, the impact of over a year of interest rate hikes, poor monsoon, etc. are challenges. A recession in US and Europe means demand for Indian exports reduces. All of this, coupled with fears that the post-COVID consumption frenzy could fizzle out, means that an average of 6% growth this financial year is a best-case scenario. But realistically, is that enough? Is fastest growing tag enough to improve the quality of life of Indians? Should consumption be boosted with faster interest rate cuts, since there is a concern that that could be hit because of high interest rates? What can India do to go back to double-digit growth era? And can India shield herself from global recession? Most importantly, how do we ensure more equitable growth for all citizens? To speak on this, I'm joined first by S&P Global Ratings economist Vishrut Rana. Mr. Rana, thank you so much for speaking with us this evening on Beyond the Headline. Let me start with the 6% forecast number for FY24 that you've put out. If the Indian outlook is so rosy, we've grown at 7.2% in FY23, that's financial year 2023. Why has the growth forecast for next year been retained at 6%? Isn't there a case to raise that outlook?
Yeah, that's a great starting point. I think one of the factors that's affecting our India outlook, as across the region, in fact, is that the external outlook is looking more challenging this year. Against that backdrop, I think we're reluctant to pencil in higher numbers because the external factors could be weighing on the growth momentum in Asia Pacific. They have been a factor so far through the course of this year. And that external demand could be a factor. We also think in India's case that given some of the slowdown in private consumption activity that we are seeing, it has been modest, anticipated. Some of the pent-up demand is coming off following the reopening of the economy. Monetary policy is, of course, on the tight side. As a result, we are going to see some moderation in consumer activity. Next year, we expect 6.9% growth for the next fiscal year, so fiscal 24-25. And the reason is that consumer activity is expected to come back. We think that private consumer demand will now return to normal next year. On top of that, there'll be favorable tailwind from normalizing global economies as well. And of course, inflation coming down will help the picture there as well.
All right, so in that case, explain how we go from 6% in FY24 to 6.9% in the following year. And if there's a problem with private consumption in FY24, how does that get fixed in the following year?
Yeah, that's a great way to look at it. So as I mentioned, this year we are seeing some headwinds to private consumer activity. What we had last fiscal year was, strong reopening demand, this very sharp pickup in contract-based services activity once the lockdowns had ended, etc. And some of that effect is still continuing till now. Although that effect is kind of petering out as well, and that's what's affecting the consumer outlook for this year. So we're expecting, some consumer demand softness going forward for the rest of this fiscal year. When that effect fades next year, that's going to give this arithmetic boost to the consumer numbers. The year-on-year growth number looks favorable when you compare against the weaker year. So that's part of the story why you see this fairly sharp jump in the overall headline growth number between this fiscal year and the next fiscal year from 6.0 to 6.9. So indeed, a pickup in activity. It is made a little bit more favorable by having a weaker year ahead of it. So yeah, so that 6.9% reflects some normalization coming back into the picture.
Okay. Okay, so the overall sort of narrative headline picture is that India is the fastest growing large economy, the fastest growing in Asia Pacific, a bright spot in an otherwise gloomy firmament. Put that into perspective. Is that a relative sort of, relief that we're looking at?
Yeah, certainly. So we have a number of fast-growing economies in the Asia-Pacific region. This region, of course, one of the main global growth drivers. So, for example, for China, we expect 5.2% growth this year, and then a bit of a pickup next year as well. So this region kind of has several of these faster growing economies. I should also point out two other ones that come to mind, which is the Philippines and Vietnam. So what kind of puts these economies in a group together with India, that they're emerging markets, they're high growth economies, and we see similar sort of growth dynamics for those two in particular, with externally driven growth being at the forefront. What sets India apart is that it is still entering the middle income levels, right? It is still, the GDP per capita levels are still pretty low. We still have room to catch up on that front, and that kind of aids the growth story a little bit, because there's a lot of low-hanging fruit to capture. The gains from trade are likely to be very positive as well. We're going to see the unleashing of the Indian consumer over the next few years, a very services-led story, but now also aided by improving FDI outlooks and resilient financial sector as well.
I was going through the details of your report, and one of the charts, of course, is a forecast for GDP and for inflation, etc. But one of the charts also looks at the exchange rate outlook, and this says that the dollar to the rupee, or the rupee to the dollar, will be 83.5 by 2024. It's only going to get more and more expensive. Why is that, if this is one of the fastest growing economies in this space?
Yeah, I'm going to try. So the exchange rate should not be seen as a indicator of the health of the overall economy. So a weaker exchange rate isn't necessarily bad for growth. For example, a weaker exchange rate can be favorable for exports, right? It makes your exports cheaper to the rest of the world, and which is why several policymakers across Asia Pacific, in particular, prefer to have weaker exchange rates, so that it gives the exports that competitive advantage. So there isn't that direct link that we see between strong growth and the exchange rate. The exchange rate is likely more to be driven by the current account balances, as well as the portfolio flows, And while India remains a very strongly growing economy, the demand for goods from abroad is going to be very strong. And that's one of the factors that's affecting our exchange rate outlook and why we think the exchange rate is going to weaken from here.
All right. Thank you so much for speaking with us. There, the S&P voice explaining those numbers and their report, Vishrut Rana speaking to us. I'm taking that conversation further. Madhavan Narayanan, senior journalist, is with me on the show. I'm also speaking with Sanjeev Ahluwalia, economist and advisor, ORF. Welcome to both of you. Madhavan, let me begin, with your take. And we've been seeing a lot of these, frankly, very heartening and great headlines, right? That fastest growing economy, brightest spot in the world. We saw a lot of that talk when the Prime Minister was in the US as well. Is 6 to 7% the new normal in this day and age? Is that a fair enough number that we should be celebrating?
We sort of, let's say, not happy, is there a word below happy, but, there's nothing to panic. There's a lot of stability in the economy. Stable, sustainable 6.5 to 7% growth looks more realistic than before. But then let me add that we've just seen COVID, which was like a black swan event for the entire planet. We also are still not sure how the monsoon this year is going to be. So India remains a monsoon-dependent economy, not just for agriculture, because a huge amount of the consumer demand comes from the kind of surplus generated by agriculture, because that determines disposable incomes. And therefore, we are not as strong as it might seem. But if these two factors, as they say, ceteris paribus in economics, other things remaining constant, the monsoon's fine and there is no untoward event like a war or something like this, we are looking good as in terms of three things. Inflation is under control. Interest rates, India is probably going to be the first economy that's going to see an interest rate cut or a prolonged pause at least to keep things going. But we have to look at the fact that this so-called quote-unquote good economic growth, although good in comparison to other economies, including major economies, is both. Now, this is the interesting part, Tamanna. It is the cause as well as the consequence of this is the demographic transition that India is going through. You have a huge consumer economy that drives demand, that drives growth, but it is the same demographics that is going to seek answers in terms of greater employment. And the new technologies are not good enough to generate employment in that large number. Raghuram Rajan used to have a ballpark figure of 1 million people entering the workforce every month. Even that's not true, and people are not starving, that's good news, because India has got sufficient food, and the roti kapra problem is somewhat under control. So that is a good thing, but that is not something to rest our laurels on, because employment, productivity, and income generation are big challenges, and you have to sustain this. And the figure that we are talking about, 6.7, in view of the new technologies, are not good enough to generate jobs like they used to. 6% growth about 40 years ago meant a lot more jobs than it does now, because the nature of productivity has changed. But the services-led growth, which Vishrut Rana of S&P spoke extensively about, is an interesting thing, because services is not a bad thing. It can generate a lot of jobs that have a recurring in nature. It improves the quality of life if properly done, and it's not a disguised form of unemployment. And there's nothing to be ashamed of in having a services-led growth, because the world has changed a lot. But having said that, who's going to keep track of both a large distribution of income as well as the generation of jobs? The jury is out on that. And let me also say that we are going to have elections next year, and political uncertainty remains a certain issue of concern, and though not the way it used to be in the 1990s. So all told, I would say, let's not be pessimistic, but this is not something to celebrate.
No, it's not about pessimistic, Madhavan. The idea is to be realistic. What does this mean? What does this mean for Indians? And the reason why I wanted to bring this up on Beyond the Headline and on Mirror Now is because the economic headlines have made it to the center of political discourse. They
Yeah,
are also, political planks, that this is a government that has delivered. This is a government that has delivered the fastest
I
growing
complete.
economy in the middle of a Ukraine-Russia war, in the middle of geopolitical headwinds, when the US and Europe are expected to go into recession. India is standing strong. I want to understand how far that goes, and is this because of the way the Indian economy is built? Or is this truly something that the current government can take credit for?
Let me answer the last question first. This demographic transition, as well as some of the food security that is driving this kind of growth with the demographic transition, is something that has been in the works for a while. For instance, what happened with the MNREGA, the Mahatma Gandhi National Rural Employment Guarantee Program, provided a stability to the economy a decade ago, the results of which we are seeing now in terms of a huge consumer demand. So that's one way of looking at it. But so no single party can take credit for it, because the current government can say we built a lot of highways because under the SAYS law, supply creates its own demand, construction labor generates employment. So no single party can take credit. What I am concerned about is your question, Tamanna, on what does it mean for Indians as opposed to India, because it's not as simple as that. The trickle down theory is not really working as well as its proponents claim. This whole simple habit of measuring GDP as a number and assuming that it translates as good times to come for the economy or the people is not a easy one. So you'll have to extrapolate that with things like the capital labor ratio, which I believe is increasingly tilted towards capital in a lot of industries where blue collar workers are required. You have robotics and all that coming in. On the other hand, some industries like artificial intelligence, small amount of capital can create a hell of a lot of incomes for a certain section of the people. So if you're looking at all this together, I would say there's a lot of nitty-gritty work to be done. If political indications are any required, the Karnataka elections were a good example of how a strong BJP-led government at the center and in the state can lose state elections in India's technologically most advanced state because the benefits did not sufficiently translate to the ordinary people. So I'm a big fan of political economy. I'm saying economics gives you growth, but growth is the beginning of a story, not an end unless you do statistics for a living. So I think there's a lot to be done. But having said that, I don't want to make it a simple case of using this to criticize the government. It's not that. This country is progressing, I would say, in spite of the government sometimes and because of the government sometimes. It depends on which angle you're looking at it. So I think there is a secular movement of India towards a high growth path, and that's a great thing. And we are also, as they say, the sun and the moon and the stars are lining up, because from a point of view of technology, food security, and in terms of skilled population, young population, India's median age is only 28, which means half of Indians are young and able-bodied. So as long as you give them a certain thing to do productively, it's a great time to be in. But we discussed earlier in another show today, we also have to worry about capital infrastructure for human capital. We have to worry about how to nurture growth in an orderly fashion so that some of the side effects, such as pollution, doesn't add up.
Absolutely. And equitable growth. Growth
Exactly.
can't only be, because Tesla will come to India to sell to a few billionaires.
Absolutely.
Public transport.
Decongestion
public
of
transport
city.
is growth.
Yeah, public transport, decongestion, a certain amount of efforts to curb large-scale rural migration into cities, because that will only add to the stress if it doesn't. So you need more balanced regional development. We also need a transition regime where some of the gains of highly automated industries are translated as benefits for ordinary citizens. There's a lot of workman-like administration required at various levels. You simply cannot throw some ease of doing business rankings and throw some capital into the economy and hope that things will work out. I'm sorry, this is going to be, as they say in
cricket,
the
numbers are great. The headline numbers are great. We should be happy that we're not as bad off as other nations.
Yeah, and one point, Yeah, one
Yeah,
point, Tamanna.
quickly, Madhavan, yes.
Yeah, macroeconomically speaking, a slightly weaker rupee may not be a bad thing because it gives us protection
Yes.
against Chinese imports. It also keeps the export engine buzzing. And it's a double engine economy we have, to borrow that memorable phrase from BJP's politics. We have a domestic engine and we also have an export engine, including $100 billion in remittances.
No, the
So
dollar
India,
at 83.5 is bad for those travelers who anyway now have to pay TCS.
yeah, but
And
everything is not,
and it's bad for
everything is
those who want to
not,
study abroad.
yeah, but you cannot equate the economy with just the lifestyles of a small section of urban citizens.
Absolutely, absolutely, understood.
Yeah, but
I will have to wrap, Madhavan, but thank you so much for joining us on the show. And I'm moving on to the other